Everyone is so wrong about what's about to come for Ethereum and crypto. That's the latest message out from Wall Street veteran Tom Lee. And he's not just talking the talk, he's putting his money where his mouth is. In the last week, after that violent flash crash, Tom Lee used his Ethereum treasury company, BitMine, to buy almost $500 million worth of Ethereum. While most people were scared, he pressed the buy button. That is conviction. In this video, we are going to go over Tom Lee's latest outlook on the crypto market, including the framework he uses to know when to go all in. Tom Lee runs on 3 principles: simple, testable, uncomfortable. They made him bullish while others were panicking, and they have him leaning hard into Ethereum and Bitcoin for the next 3 months. Now, before we jump in, only a small percentage of my viewers are actually subscribed. If you enjoy staying up to date with finance content, consider subscribing or liking the video. It's free and you can always change your mind. Now, let's dive into Tom Lee's 3-part investing framework. When it comes to investing, Tom Lee is a veteran. He uses a simple playbook to know when to go all in on an investment. 3 rules. They sound obvious, they feel uncomfortable, and they work. Let's start with Tom's first rule, being that when it comes to investing, if you want to out-return the market, the crowd is often wrong and you have to go against the consensus view.
We always keep in the back of our minds is that consensus tends to be risk-averse and crowded. So meaning what is a widely held view and might even be the most logical is probably also the most logical for most people, and therefore it's not actionable. So we try to think about where the variance or the surprise would occur relative to consensus. And often it makes you come to a counterintuitive conclusion. That process would make you bullish in the midst of a sell-off, and it would make you bearish at the top.
So that's Tom in his own words. When everyone agrees on a neat story, that's usually when the surprise shows up. If you want to get outperformance with your investing, by very definition, it's not going to come from taking the consensus view with the crowd. So how does this relate to crypto? Well, right now, crypto has a very neat story. Spend 10 minutes on crypto Twitter or crypto YouTube and you'll hear the same line on repeat. This cycle tops in the next 3 months. The logic sounds tidy. The rationale makes sense. Every 4-year cycle in crypto has peaked in Q4 after the halving. Therefore, the next 3 months before the end of 2025 must be the peak. It's clean, it's logical, it's also crowded. Here's why it matters. When everyone is betting on the same trade, there's nothing left to do. Crowded stories stop working. That's the exact moment Tom looks for the surprise. Let's look at Tom Lee's actions versus the consensus narrative in crypto right now. After last week's flush, while the entire market was panicking, what did Tom Lee do? Well, BitMine bought about $480 million of Ethereum. That wasn't a one-off either. That was just the latest of some extremely heavy buying. The week before, they added $821 million more. Before these latest buys, they already held over 2.83 million Ethereum and a combined total of $13.4 billion in both cash and crypto. New totals put them holding roughly 2.96 million Ethereum after the crash. Let's ask the obvious question. If Tom thought crypto was going to peak in the next 3 months, would he be loading up on hundreds of millions of dollars in Ethereum right now? Or would he be selling off his positions into strength and biding his time for better prices? His actions answer it. It's clear Tom Lee isn't just being a contrarian for the point of going against the crowd. What does he know that the consensus is missing? Well, the macroeconomic data backs up Tom's bet. Right now, we're at the start of an interest rate cutting cycle. The business cycle has been delayed, not finished. Global liquidity is currently turning up. Money supply is rising. When the cost of borrowing money falls and the amount of money available rises, the assets furthest out on the risk curve, such as Bitcoin and Ethereum, usually benefit the most and the fastest. So the neat consensus says crypto will top by year end because that's how the old cycles worked. But Tom's first principle of investing says our current setup is different, policy is shifting, liquidity is rising, demographics are on your side, and his recent trades say the path most people aren't positioned for is up, not over. Simple takeaway, when the crowd was certain and scared, Tom bought more Ethereum. That's his first rule in action. That leads us into Tom Lee's second investing principle. Look at who's really driving the market, not just today, but over the next decade. In one word, demographics.
We always keep in the back of our minds is that there are longer term drivers of markets, and I think the most underappreciated is demographics. That demographics are more important than even economic policy. And it's something I learned when I was a wireless analyst. Before I became a strategist in 2007, I'd spent the prior 14 years of my career as a technology analyst covering the wireless industry. And one of the things I learned was that the potential of the wireless industry was underestimated by most people because they didn't think about the demographic impact. That if 18-year-olds had a adoption rate of 100%, like you could see it in Korea in the early days, that meant that as they became 40 and 50-year-olds, the penetration rate of older adults would get to 100%. That means wireless would grow vastly over time because of this demographic impact. We found that the stock market really follows very closely the demographic cycles of people aged 30 to 50. And that's kept us bullish since 2009 because that's when that demographic actually bottomed.
Tom Lee's message is clear. If you want to outperform in investing, you need to look at what the true drive of the market is, demographics. So what does that actually mean for crypto? It means you stop arguing about the next 3 months and look at where the money is going to be coming from over the next 10 years. In case you weren't aware, we are living through the great wealth transfer. By 2045, roughly $84 trillion is set to move from baby boomers to millennials and Gen Z. In the US alone, stretch the window to 2048 and the figure climbs to $124 trillion. This isn't a guess, this is a fact. Zoom in and it's not a trickle of money, it's a tsunami. One estimate has $1.4 trillion per year landing with younger generations over the next decade as part of this wealth transfer. Now ask yourself the only question that matters. What will younger generations and younger investors actually do with this tsunami of capital? Well, the answer is pretty obvious. Multiple surveys show where the money is heading. In recent polling, roughly 73% of Gen Z and millennial investors said they favor Bitcoin over gold as a long-term investment. That's a generational preference shift away from legacy investments toward digital assets. And the on-ramp is already there. Adoption isn't just anecdotes, it's visible in mainstream finance. In 2025, a majority of institutional respondents in a global survey said they plan to allocate over 5% of AUM to digital assets, pushing crypto further into the normal bucket. Meanwhile, stablecoins, the day-to-day plumbing that pulls people onto crypto rails, have exploded from a niche tool into real payment infrastructure. Visa's own research shows global stablecoin volume jumping from approximately $3.5 trillion in 2023 to over $5.5 trillion in 2024. Other analyses put 2025 run rates well into the double-digit trillions and rising, with banks and payment giants testing settlement on these rails. The direction of crypto adoption is only going one way, up. Layer all of those together and the picture is simple. Trillions are in motion from older hands to younger investors. Those younger investors already express a preference for Bitcoin and Ethereum over bonds and gold. Institutions are formalizing allocations, and the payment rails that make crypto useful, especially stablecoins, are scaling fast. That's why Tom keeps demographics at the center of his investing framework. The buyers of the 2000s and 30s are telling you what they want today, and the market structure is lining up to deliver it. As tens of trillions in boomer wealth moves to younger hands, that money has to find a new home, and it won't be piling into bonds and gold. This generation's default investment is digital. It's going into Bitcoin, Ethereum, and crypto. That takes us to Tom Lee's next investing principle, the one traders ignore at their own expense: don't fight the Fed.
You can't fight the Fed. So in 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception, because in late 2022, the Fed had to be hawkish optically, but actually they had turned dovish. That's the reason we had turned bullish and stayed bullish in 2023, because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets.
So what does Tom's third rule of not fighting the Fed mean for crypto right now? Well, right now it's flashing green for crypto, because everything the Fed is currently signaling is bullish for crypto. We've started a rate cutting cycle. Liquidity is picking up, money supply is turning higher. When the cost of borrowing money falls and the amount of money in the market rises, it has to find a home somewhere. And as we said earlier, it usually shows up first in the parts of the market furthest out on the risk curve, Bitcoin and Ethereum. Tom's rule is simple: when the Fed's easing, don't overthink it. Prices tend to follow liquidity. And if we look at the data, institutional investors are agreeing with Tom Lee's sentiment. In the first few weeks of October, US spot Ethereum funds stacked 6 straight days of net inflows, including $182 million on October 6th. That's institutions stepping back in after a messy summer. Zoom out and the story holds. Cumulative Ethereum ETF net inflows are around $15 billion since launch. That's real demand flowing through regulated pipes even with all the volatility. Put that together with the demographics we just covered and you've got timing and buyers lining up at the same moment. That's why Tom is acting now and buying up, while the Fed's only just begun opening the spigot and the money's moving, not after it's obvious. So that's Tom Lee's 3 investing principles. First, the consensus view is often crowded and wrong. Second, look at demographics as the real driver of markets. And third, don't fight the Fed. This is why he thinks the crowd's view right now is dead wrong about Bitcoin, Ethereum, and crypto. We know he's bullish, but how bullish? In his latest keynote, he put real numbers on it. Let's take a look at where he thinks the market is heading over the next 3 months.
I'm still bullish on Bitcoin. In the fourth quarter, seasonally, Bitcoin's strong, but now we have the Fed flipping dovish after being essentially hawkish all year. That's a tailwind for Bitcoin. So I think Bitcoin gets to 200 to 250,000 by the end of the year. And that aligns with Mark Newton's technical targets. Ethereum, as a price ratio to Bitcoin, should recover to its prior, let's say, either average or at least 5-year highs, okay? Mm-hmm. Using a $250,000 Bitcoin, that implies somewhere between 10 and 12,000 for Ethereum by the end of the year. But I do think Ethereum is going to exceed those prior highs, and that's why I think when we get to 12, 15,000, that's what you call, real price discovery, but I don't think that would be the ceiling for Ethereum.
So there's Tom in his own words on where he thinks Bitcoin and Ethereum will be by the end of this year. Bitcoin he expects to be somewhere between $200,000 and $250,000. And he expects Ethereum to be somewhere between $10,000 and $12,000. Here's what gives him the confidence in that prediction. Tom's 3 rules all say the same thing. The consensus view of the 4-year cycle is off, demographics are a major tailwind for crypto, and the Fed's current stance plus liquidity point to prices going up, not down. Also, his behavior matches his words. He's not just talking the talk, he's walking the walk. We can see him buying any crypto dip at scale. So let's put it all together. Here's the 3-part framework Tom Lee uses to invest, the one that's driven his success for decades. First, the consensus view is crowded and often wrong. Second, demographics are the real engine of markets. Third, don't fight the Fed. Applied to today, it's a simple read. The neat end-of-cycle story is overcrowded, the next decade's buyers are younger and digital first, and policy and liquidity are turning supportive for crypto. That's why Tom Lee is so confident in making huge predictions for both Bitcoin and Ethereum for the end of the year. All parts of his investing framework point to the same conclusion. Crypto prices are going much, much higher. Now, if you watched this far into the video, you're clearly interested in crypto. If you want the latest news in crypto, expert opinions, and most recent on-chain data and signals, sign up to the Crypto Nutshell. It's my free 5-minute daily newsletter on what actually moves the crypto market. It's fast, it's free, and it'll make you a better crypto investor. First link in the description, put in your email, and you're good to go. Anyway, guys, that's all for today. Thanks for watching, and I'll see you in the next one.